This publication provides general information only and is not legal or professional advice. CPA Australia gives no warranties as to its accuracy, completeness, or suitability and disclaims all liability for reliance on it. Listeners should seek their own independent advice for their circumstances.
There's a lot of dirty money floating through the Australian economy. We know the illicit drug market is worth more than $12 billion. The illicit tobacco market is worth more than $7 billion. So just those two crime types alone is close to $20 billion worth of illegal money in the Australian economy.
Converting dirty money into so-called clean cash is the fundamental aim of all money laundering operations. Just how the cleaning process works can happen in a manner of nefarious ways, including using the financial system or moving cash via couriers. I'm Jacqueline Blondell, and in this, our second series of Crime by Numbers, we delve into the murky depths of the world's laundromat and unpack why money laundering is so harmful and what we can all do to clean it up. This is Episode 1, Inside the Laundry. In Episode 1, we're going to look at the origins of money laundering, how the process works, and the sheer cost to the global and local economies. Even though intelligence and technology have improved detection rates, money laundering is widespread and particularly difficult to track and control. But the crime is as old as time. As far back as the Tang Dynasty, Chinese merchants used the flying money system to move assets outside of local jurisdictions to avoid confiscation by bureaucrats. This system allowed traders to remain anonymous when moving money about. But why do we use the cleaning analogy for moving money about in nefarious ways? Here's Jeff Peck, a former fraud squad detective with Victoria Police's major fraud group. He's now Managing Director of Forensic Integrity Solutions.
This sort of activity has been going on for millennia, but it's probably in the 1920s, in the modern sort of era, where money laundering came to the fore. And it's when criminals were able to then generate vast amounts of profit. Because, of course, if you're a petty criminal and you can generate even $10,000 profit, you don't necessarily need to launder that. You can spend that and it won't raise any suspicions. But when you're generating vast quantities of profits and money, you need to then distance that so you can use it. And, of course, this came to the fore in the 1920s during Prohibition in the US. Think of Al Capone and the sort of vast sums of money that he was and his gang was starting to generate, and then have a think about what brought him unstuck was tax evasion. And criminals don't like paying tax. They want to spend every cent that they can earn. And the process was invented in the sort of 20s, where it was invested in legitimate businesses, where money's illegal proceeds of crime could be then mixed with legitimate income. Laundromats were a favourite business back in those days, hence laundering money.
While Capone's literal use of laundromats can be viewed as apocryphal, the term money laundering didn't come into use until the 1970s. And what event ushered it into the lexicon? It was the Watergate scandal, where illegal campaign contributions were funneled through Mexican banks. The fallout of the affair led to President Nixon's resignation. As of 2025, AI security company Napier AI calculated the worldwide cost of money laundering as $5.5 trillion, around 5% of global GDP. Breaking down that figure by country shows that economic heavyweights, the US, China, India, and Germany, are hardest hit in absolute terms by money laundering. For example, in the US, nearly $750 billion is laundered annually. In Australia, it's estimated that money laundering costs the Australian economy around 60 billion Australian dollars a year. This is money to cover specific crime and fraud. And which crime? Number 1, illicit drugs. Number 2, tax revenue crimes. Number 3, government-funded programs fraud. These crimes that predicate money laundering are high risk and on the increase, according to a report by AUSTRAC, Australia's anti-money laundering and counter-terrorism regulator and financial intelligence unit. Since the AML-CTF Act was enforced in 2007, AUSTRAC has been regulating around 19,000 financial businesses, banks, money service providers, gambling companies, and bullion dealers. cryptocurrency dealers were added in 2018. For the first time in 2026, accountants, lawyers, real estate agents, and dealers in precious gems and metal will be added, bringing the total number of reporters as of July 2026 to around 100,000. Here's Brendan Thomas, AUSTRAC CEO, on the types of crimes that predicate money laundering.
We know the illicit drug market in Australia is worth more than $12 billion. We know the illicit tobacco market in Australia is worth more than $7 billion. So just those two crime types alone is close to $20 billion worth of illegal money in the Australian economy. So every dollar of that is illegal. Every dollar of that is being laundered or needs to be laundered by somebody to try and make it look legitimate. And that's only two types of crime. When you throw on top of that taxation fraud, scams, cybercrime, all sorts of other crime types, it's a much bigger volume of money. There's a lot of dirty money floating through the Australian economy.
It's a common misconception that money laundering is a victimless crime, but that's far from the truth, notes Detective Sergeant Chris Wilson of the Australian Federal Police's Cyber Coordination Centre.
The term victimless crime gets thrown around a lot. It's far from the truth. And I mean, really, the victims are front and centre, really. It's the community. Yeah, I can sort of break it down in terms of, the public sector, for example, in 2023, 2024. Money laundering cost the public sector approximately $10.8 billion and the private sector $12.7 billion. Now, that's a considerable sum of money by any stretch of the imagination. But when you break it down further, the community really suffers here, including businesses and financial institutions. So legitimate businesses can be undercut or infiltrated. Banks face financial losses, regulatory consequences and reputational damage when criminals exploit their systems. Government departments and taxpayers, which is a large portion of the Australian population, also suffer here as well. What that can result in is reduced tax revenue, which increases the cost of policing and regulation. And, that's just one cost that would then fall onto taxpayers as a result of money laundering. And then you have victims of the original crime itself, people harmed by scams, fraud, drug crime, any means of exploitation or corruption. And, effectively what happens there is that the money laundering allows those crimes to remain profitable, which is why it's a continual battle from law enforcement to combat it.
Organised crime's involvement in fraud of government programs, such as the NDIS, is an emerging worry. This is Amanda Wood, Managing Director of Kroll's Investigations, Diligence and Compliance Practice. She has more than 25 years' experience in anti-money laundering and counter-terrorism financing, including stints at AUSTRAC, APRA and Treasury.
The government benefits provide a sort of honeypot to criminals. If you can access government-related benefits, then there's obviously welfare fraud and other things, fraud in relation to the NDIS, are all tied up in that sort of bucket when we're talking about that sort of government benefits fraud. One of the things about Australia is we do a good job in being transparent around the threat environment. AUSTRAC and other agencies produce a lot of information which is helpful to reporting entities to understand the types of threats that we're looking at. Whether that extends into other jurisdictions, what I've seen with other countries in their national risk assessments and other things is that there's probably lower level of detail, particularly not so much in the larger economies, but in the smaller sort of economies around the region, and particularly you don't see as much detail around the types of criminal threats that they might be exposed to. So it's hard to say how it compares with other countries, but we do have in the Australian context, large public schemes such as the NDIS, which, there's some fairly well publicised concerns about fraud and other things happening through that scheme. So I think that all ties into the nature of the benefits that are provided in Australia and then the attractiveness of trying to access those things by criminals and others.
How do money launderers ply their trade? The three-step process has barely changed for thousands of years. Remember the Chinese merchants using the flying money system? This was an early form of placement and layering of funds, a process still used today. Here's Jeff Peck.
The first element is placement. So this is where you need to introduce your ill-gotten gains into the financial system. It might be structured deposits where you small amounts of money in multiple bank accounts with banks to get the money into the financial system. Once it's in there, then there's a process called layering. So this is where the distance is created between the illegal activities and the funds, transferring across jurisdictions, transferring across multiple bank accounts, purchasing assets that can then be resold. It's just creating that distance. It can be quite complex. And then there's integration where the criminals are satisfied that the money is clean enough to be able to then withdraw out of the banking system and either spend it, reinvest it in criminal activities, or to go and buy assets.
To understand how this process works in practice, here's a case Jeff Peck was involved with when he was at the Victoria Police. In this case, involving an organisation established in Nauru, cash was moved out of the country through various jurisdictions, cleaned and returned to the country of origin through a process known as round-tripping.
In that case, an organisation was fraudulently induced to invest in a non-existent investment scheme and ultimately invested $60 million. But the first tranche of money was deposited in a lawyer's bank account in London. So that was the placement stage. That money was then transferred from London to a bank in Switzerland, then from that bank in Switzerland back to London, then from that London account to an organisation set up in Antigua, but it had an account in Switzerland. So the money didn't actually go to Antigua, it just went to another account in Switzerland. Then those monies were split into accounts in northern Italy and the US. And then the Australian offenders repatriated money to Australia via Vanuatu and then were able to buy assets with it. So you can see the quite complex layering of just transferring around multiple jurisdictions, multiple companies, multiple bank accounts, then back into Australia via Vanuatu, pull it out of the system.
As you can imagine, this nest of snakes took some time to unravel.
We had to appoint an investigating magistrate in Switzerland to execute search warrants for the Swiss banks, the New York district attorney, for the money that hit the US. It took us 7 years.
And sending all that money back and forth across the globe had a major cost for the fraudsters. They had to pay the money launderers. And that didn't come cheap. Here's Jeff Peck again.
Now, in that case, it actually cost them $8.5 million because it turns out they got most of their money, they got $8.5 million stolen by other criminals. That is another risk that criminals find. If they don't trust their money launderers, they get ripped off themselves, which is what happened in that case.
As the Nauru case shows, shell companies are used as vehicles in the money laundering process. But they are also used for a variety of legitimate processes, including reverse merger, where a private company gains a controlling interest in a public shell company, thus avoiding the costly process of an initial public listing on the stock market. The trick, however, is sorting the legitimate from the illegitimate. Here's Dr. Milind Tiwari, Senior Lecturer at the Australian Graduate School of Policing and Security at Charles Sturt University in Canberra. His research expertise is money laundering.
There is no single rule to distinguish between them. It is actually an array of red flags which are involved. At times, you would see some of the entities have a very complex beneficial ownership. There are cross-border transactions that are taking place, which does not align with the purpose for which the entity is incorporated. Similarly, there is no change in information in terms of their financial information. And suddenly, you would see large amount of transactions taking place through those entities. At times, you would see some of those entities being incorporated at the same address. So these are just some of red flags which requires further investigation. Not saying that it is a sure shot evidence that something is wrong, but yes, those are the starting points.
Bank capture or regulatory capture can be a stage in the process. This is an extreme example of systemic regulatory failure. Banks are heavily regulated under anti-money laundering regimes around the world. When these failures are uncovered, the fines are eye-watering. Take the case of Danske Bank, which was fined $2 billion when suspicious transactions moving through its Estonian branch were spotted. These transactions amounted to around 200 billion euros. During 2009 to 2014, more than $4.5 billion was drained from one MDB, Malaysia's sovereign wealth fund. Several international banks were implicated. One investment bank alone paid fines of $2.9 billion. Closer to home, In 2020, a major Australian bank was fined 1.3 billion Australian dollars for underreporting more than 19 million shady foreign transactions. This was a record sum for Australia. When it comes to bank infiltration by criminals, a 2024 case in Australia revolutionised money laundering detection methods. AUSTRAC's Fintel alliance with the Big Four banks and financial intelligence with the Western Australian Police set the investigative blueprint with Operation Taipan. This operation uncovered a syndicate using Australian bank intelligent deposit machines. When cash is deposited in these machines, it's instantly counted and immediately available. Jeff Peck explains how Operation Taipan worked.
In late 2024, a very large money laundering syndicate was dismantled by Victoria Police. A person called Bolyang Lu and his co-accused Tao Zhu, they laundered about $60 million between 2020 and 2021. And there was an undercover police operation where an undercover operative was talking to Lu, wanting to essentially launder $100,000 into crypto. And Lu said, look, I'm pretty busy at the moment, but when I'm dealing with my current client, I can handle about $1 million a week. And they were just funneling large amounts of cash through multiple ATMs and a whole bunch of different bank accounts.
In our next episode, we delve into how money mules operate and the scams that lie behind the money laundering process. Also, how the metaverse is transforming money laundering and making the detection process a whole lot trickier. That's next on Crime by Numbers.